Good morning, everybody. Thank you so much for making some time this morning to meet me for a coffee. I was just on the DAT podcast with Ken and Dean, and we were talking about RFP strategies. And there have been a lot of questions in the freight market from all sides, from brokers, from carriers, from shippers, especially on what to expect for RFP season as that's coming up quickly. And I think that that ties in perfectly with what we're going to discuss today, because what I continue to advise is that this is going to be heavily dependent on what that external event is that causes a change in the rate environment, and that will be driven by trucking volumes. And so that causes us to look backwards at macroeconomics and see what's going on in the economy. What is the outlook for any significant change in 2024? Is there a chance for some change in the macroeconomy, which will then lead into the freight markets? So without further ado, I want to bring on today's guest. I have James joining us. James is the Senior Economist at Cushman and Wakefield. Thank you so much for coming on the show, James.
Yeah, thanks so much for having me. Excited to be here.
Awesome. Well, for anyone who maybe doesn't know who Cushman and Wakefield is or what a senior economist would do there, can you kind of give us a little bit of background on who you are, what you've done, what you do now, and where you're at currently?
Yeah, absolutely. So Cushman & Wakefield is a global commercial real estate service provider. So that can be basically anything related to commercial real estate. Primarily, if you think about brokering lease agreements, whether that's for an office building or a retailer going into a shopping mall, kind of everything under the sun there. But it's not just brokerage. So it also includes facilities management, and then advising and brokering investment sales deals too. So kind of anything related to commercial real estate we do. And my role here is really to provide thought leadership, analyze what's going on in the economy, and how that translates into, demand supply fundamentals for the market. So, for example, what a landlord could expect to get for a rental rate when they sign someone up to sign a lease, that kind of thing, but much, much more. So my background is primarily as a macroeconomist, focusing on consumer spending. So I think we're going to get into some of that today.
Yeah, absolutely. I was going to say, and a lot of people, this is the point in my podcast where people are like, isn't this a freight podcast? And what does this have to do with freight? Which, as I explained to you, we are obviously dependent in freight. If you think about trucking 10 miles, everything that moves on a truck is in some way probably tied to manufacturing, imports, consumer spending. And so it's all based on the demand side of that equation. And so we are here making sure that we're talking with economists to understand what is going on in the macroeconomy, because that's going to directly impact the markets that we operate in. So you may not have known it until now, but you actually are an economist for the freight markets too. It's just, we're happy to listen in and let you apply your work to what we're doing as well.
It's all related. So
it is. That's one of the fun things about economics. And I would say that I'm kind of nerd out on economics now. I did have to study it in school because I was a business major. I was a solid A student, and then I got B's and C's in economics in college. So that's why I let people like you talk, because I can appreciate it, but I clearly don't understand it that well. So I'm going to let the experts do what they do best. So I wanted to ask you real quick, because you did just talk about in your intro, Cushman and Wakefield, talking about commercial real estate. And I think that a lot of people, myself included, at one point, when we hear commercial real estate, I think of office buildings. And I'm thinking more of, these large office buildings that are either sitting vacant right now or that were all built in the last years. But outside of that, what else falls into commercial real estate? Because I'm sure that that is not a correct assumption.
Yeah, no, I'm glad you brought that up, because I mean, office buildings really are at this point in time kind of the poster child for our industry, and not necessarily in a good way. If anyone reads the Wall Street Journal or turns on CNBC, there's a lot of news about just hybrid work and
Right.
office vacancies and what that's going to mean for the economy, for banks who kind of have lent out against those assets. So that's one part of commercial real estate. And yes, it is an important part, but just for some context, we kind of think about kind of the four main property types within commercial real estate being your office buildings, retail buildings. So that could be shopping centers, malls, that kind of thing. And then multifamily. I know it's kind of residential technically, but
Mhm.
is a big investment in the commercial world, and so it's kind of a quasi commercial real estate sector. And then the industrial space, which is just for some context, that would include warehouse distribution centers, manufacturing facilities, um, and that is more than twice the size of the office market in terms of square footage.
Right.
So it's about 18 plus billion square feet of
Right.
industrial space in the US.
Yeah. So tell me a little bit about that because I think there was plenty of headlines made in recent years on the warehousing side with a lot of new ports became experienced a lot of growth, like the port of Savannah, for example. I think there was a lot of push to start building new warehouses in the Savannah, Georgia area. I saw vacancy rates as low as 1% in a lot of warehouses across the country, as we had all of this inventory coming in during the pandemic, and we still have record high inventory levels that we've been working through. But can you talk to me a little bit about what commercial real estate has looked like specifically within that warehousing and distribution side of things and where it stands today?
Yeah, I mean, it's been pretty wild, even going back prior to the pandemic. With just the rise of online shopping and the need to, get all of our orders from Amazon and everywhere else in a very quick, cost-efficient manner. And so that really kind of led the revolution, back in the 2000s, once Amazon and others started ramping up that business model, and it really just got accelerated in a huge way during the pandemic with e-commerce and those trends really accelerating. And so, to your point, I mean, many markets you could go to around the country, if there was a tenant, say a 3PL or a large retailer, and they wanted warehouse space, they couldn't get it because
Mhm.
the market was so tight. And so what that's really led to is this massive supply wave. So in the third quarter, we just released our report on the industrial market. It was a record high number of deliveries in terms of square footage for U.S. Warehouse and distribution space. And so, you've got this combination of low vacancy,
Yeah.
rapidly rising rents. And so, the economics 101 is, all right, so supply needs to respond to that. And that's exactly what we're seeing.
Yeah. And I also think that you mentioned that shift to, you kind of mentioned Amazon in there, and that's what made me think of this. But in order to fulfill orders and get them to your consumers within 1 to 2 days, I think we started to see this shift from that single consolidation or distribution point across a lot of companies to more regionalized distribution models where, I mean, everybody knows that we used to be really heavily weighted on West Coast distribution centers and warehousing facilities that would do all of the outbound order fulfillment and shipping across the US for companies. And now we've seen a push, especially across some of your larger supply chains and a lot of the mid-size shippers as well, to kind of move to these regionalized or at least maybe centralized models where they can get to all 50 states in a reasonable amount of time versus if you're trying to get an order up to New York from, Southern California. And so what has that kind of done too to impact um I think not just like the ports, port diversification led to that, right? Where we started using East Coast and Southern ports more, but also central United States, right? Like trying to be somewhere more central to get to every part of the US in a reasonable amount of time. So how is kind of regionalized distribution models? Are you seeing evidence of that continuing to grow, or are we done with that push in large and it's kind of stabilized in the commercial real estate market?
No, I think it's a big question because you're right. You used to have these massive industrial markets and like the Inland Empire and
Mhm.
northern New Jersey and Chicago, but
Right.
but now it's really over the past few years expanded into these secondary, tertiary markets.
Okay.
Basically, any city or metro area you go to around the country has some massive distribution center, and
Yeah.
that's to your point about having that very expedient supply chain, being able to get to customers in a very quick way. So I think there's still some demand in the pipeline longer term, but I think what we're seeing now though is just the expansion we saw during the pandemic. There was that pulled forward a lot of demand for
Right.
e-commerce, for just kind of the supply chain business models to catch up with what consumers had been wanting all along. It just happened in such a short time period. And so, now you're hearing about, large retailers, wholesalers, 3PLs, kind of pausing a little bit on that. And I think that has more so to do with the current economic environment and just trying to reassess, how much inventory they're going to need to hold, where it needs to
Mhm.
be, rather than just the frenzy that we saw over the past few years where we'll take a warehouse wherever we can find land if it's near people. So I think there's a pause in the market, but I think longer term there's still absolutely some demand that's out there to because consumers are always evolving too, right? We went from everything's going to be bought online to now we're seeing e-commerce as a share start to level off a bit.
I love that comment because I think there was so much speculation during the pandemic like, oh, this is it. It finally forced all the people who were resistant to buying online to be comfortable buying online. This is the only way forward now. Everyone's just going to be online consumers. And then as soon as we've seen things start to open back up more in the last 18 months, I mean, you guys track activity in shopping centers, shopping
Yeah.
malls, outlet malls, and I'm sure we've probably seen too in consumer spending habits that a lot of that is shifting back to in-person spending as opposed to online. I know I did. Like I adjusted to ordering even like clothing online, which I never did before the pandemic. And now that I can go back into a store, I'm already transitioning back into that because
Yeah.
also I think it's funny, but we did a lot of free shipping and free returns during the pandemic, and I think that that's a whole other logistics topic in and of itself. But free returns aren't actually free for the people selling those products, and in fact, reverse logistics is getting incredibly complex and expensive. And
Yep.
so now, I mean, I just recently. I was going to a wedding, ordered like 4 dresses, figured I'd just see which one I liked the most and send them back. Well, I had to pay to send every single one of them back. And so I was like, well, I'm not doing that again. Like and then I couldn't, I had to go to a FedEx or a UPS for this one or a different drop off for this one. And it's just not as convenient now. And it's not
Yeah.
free like it was. So I think that you'll,
Yeah, and I mean, you make a really good point. In the broader real estate universe, it's I don't know how familiar you are with kind of the retail narrative, but it ties in with e-commerce, right? Like the retail apocalypse. I don't know.
Mhm.
That was a very popular kind of media headline in 2018, 2019, meaning that because people are going to buy everything online, you're going to see all these store closures and nobody's going to go shopping
Yep.
anymore. What we've actually seen now, to your point, is that retail vacancy rates are the lowest they've ever been. Turns out it's very expensive to ship everything and handle returns, and even marketing online very expensive too. So I think there's a closer interplay between e-commerce and physical retail that is going to be interesting to watch over the next few years.
Yeah. So talk to me though about why the craziness stopped. Like, why are we not still spending like we were in 21 into the beginning of 2022? So I think you said you study consumer behaviors as well. So we all know that we aren't seeing the same levels of demand that we were. So what's changed? What's impacting that? And what are your thoughts on the consumer spending side of things right now and where that's headed?
Yeah, it's been I kind of categorize it into a few things, right? So there was the initial disruption of the pandemic, right, where you kind of were forced to buy things online. And spend the types of things you spent on too was different too, right? Like you couldn't go
Mhm.
out to eat, you couldn't travel. And so meanwhile, we had all the stimulus. People wanted to make the most of their time at home, so we had people remodeling home offices, so buying furniture, electronics, trying to make upgrades to their home to make it more livable and comfortable to be in for more periods of time. And so if you think about like the types of purchases those are, right? Like Peloton bikes, TVs, they're big durable goods, right? You make those purchases one time every few years at most, right? And so we kind of saw that happen in a very big way in 2020 and 2021. And now, combined with people are, concerns around COVID aren't really there anymore, and people are out traveling and doing those types of things. So just the mix of spending has kind of shifted back closer to what we're used to pre-pandemic. And then, in addition to that, we've had this leveling off in e-commerce. for similar reasons, right? As
Yeah.
yes, people are spending more for online shopping, but they're also doing it in tandem with, maybe ordering online, going to pick it up in store, things like that. So I think that's really one part of it, kind of this reversion back to the pre-pandemic trends on those two fronts. And then, there's been a lot of talk of excess savings and consumers have all this money saved up from the pandemic. That's gradually gotten a little bit less. And so just combined with sort of the
Yeah.
economic uncertainty that's out there, consumer views on the labor market are still positive. We're still seeing strong job growth, but I think that there is some caution if you look at consumer confidence and especially kind of the outlook for the next year or so. So I think that really those two things together have led to a pullback in consumer demand. Still growing, like the retail sales report today seemed like it was pretty good. But a lot of those same factors that I mentioned are still at play. People are still going out to eat in a big way, but they're not spending as much on your physical goods, especially in the discretionary categories like electronics, apparel, things like that, things that come through warehouses, right? And
Right.
so that's really the two pieces to that I'm watching right now.
Cool. And we had some graphs. I think we had it up here on a second, but could you kind of just quickly walk us through it looks like you guys produce these from Cushman and Wakefield. So just kind of anything here. I think we're looking at the spending on services. Obviously the change in that, right? And what's this other one? What is it that you guys are following here?
Yeah, so this is to my point just a second ago. So if you kind of think about consumer spending very broadly, you can buy things or physical goods or services, which would be like your entertainment,
Mhm.
travel, even healthcare kind of falls into that. So if you look at the yellow line here, this shows that for the U.S. that was over 60% of services versus goods spending prior to the
Mhm.
pandemic. And
Right.
of course, that dipped way down during the last couple of years, and has been coming back sort of slowly. But our expectation is that this is going to, eventually get back to sort of the normal mix of spending versus services versus goods. And then same thing with e-commerce too on the right. Whether you look at the U.S. or any other economy, this shows the percent of e-commerce sales versus overall retail spending, which of course had this huge spike initially in 2020 and has sort of leveled out. Maybe not quite back to the pre-pandemic trend,
Right.
perhaps a little bit higher, but certainly not that exponential type of growth that at least some people were expecting.
Right. Yeah, and that's kind of my takeaway there in summary is that like we maybe thought that the pandemic accelerated trends and that we weren't going to just see an immediate reversion back to the expected trend line, but I think by all accounts that's kind of what's been happening lately, right? Is we are reverting back to that expected trend line as opposed to we basically skipped 3 to 5 years of progress. I don't think that that's really what's going to happen here
Yeah.
as we
So
start to see that
just
trend back.
to round out that point, we did an analysis looking at modeling industrial warehouse demand, so the amount of square footage taken up by tenants in the market versus e-commerce retail sales, and estimated that about 50% of the demand that we've seen in the industrial market over the past 3 years is due to that pull forward effect
Mm,
of e-commerce that we saw from 2020 to 2022. And so the implication of that is that over the next year, 2 years, you kind of get the payback from that, right? And that's
right.
actually what we're seeing in the industrial market. If you look at the vacancy rate, it's now rising, which you could argue is a good thing, right? Because demand is cooling and there's more options for tenants, but certainly getting more into balance due to slowing demand.
Right. And I think that that rebalancing is what, especially in the trucking industry, we feel a little bit on the construction side of things because we'll have certain providers who are maybe more exposed to new construction markets and the moving of construction and building materials or even
Yep.
office furniture and things like that. And I think we're going to see kind of that significant slowdown for a couple of years as we play catch up with the demand that we had right in the last couple
Yep.
of years. And we're just kind of seeing that lull. And anybody in the freight markets right now is very familiar with that word because that's kind of what we've been doing. It's just lulling for a while as there's no better way to really put that. So I do have a question because I think that a lot of what we saw in the last 1 to 2 years around inflation has been driven by a very strong labor market. And I think that a lot of people in supply chain specifically felt the stress of labor if they were trying to run any type of warehousing or distribution operations, or anywhere that their product was being held, where the inventory was really tight. And there was just a lot of pressure put on those facilities to keep staffing up, and labor costs went up. And so, in general, kind of, can you talk to me about how is the labor market lent to the sustained inflationary environment that we saw? And I think that labor kind of became the primary focus and indicator by the Fed for were they raising rates or lowering rates based on the health of the labor market. Maybe I'm off base there, but can you tell me a little bit about how the labor market's lent to the current macroeconomic environment?
Yeah, I mean that's definitely part of it is the tightness in the labor market because I mean at the end of the day it's inflation that the Fed is concerned about, but a lot of that is tied to what we're seeing in the labor market tightness. So initially, kind of flashback a year and a half ago, um, the initial surge in inflation was primarily driven by surging energy prices. We had Russia invading Ukraine, caused energy markets to go kind of crazy, and then the supply chain disruptions that we still had lingering from, manufacturing shutdown, ships sitting off the coast, as I know you are well aware. So those were kind of the two initial big surges in inflation, but it's really spread to the labor markets and labor market tightness, which if you think about like your typical employee, right? If you're seeing your cost of groceries and housing and everything else go up, 10% plus every year, you're going to go back to your employer and say, I need a raise to keep up with that, right? And,
Right.
and so it's kind of this self-fulfilling sort of spiral, which you can get into. And so that's exactly what the Fed wants to um, get rid of. That's very bad for operating a business or managing your household budget. And so, if you look at labor market tightness now, it has improved. So, just looking at this chart here, the lighter blue line shows the number of job openings in the economy. So, fewer job openings. Obviously, there's less labor demand out there. So, another way to think about this is that the higher interest rates are working.
Mhm.
It's just taking some time because what the Fed really needs is for the labor market to cool down. And I think there's some marks around that still. We saw a
Yeah.
really strong job report for the month of September. And so I think there's some question marks out there on how fast inflation will continue to come down, which, ultimately means that interest rates are going to be higher for longer.
I've
So,
heard some recent kind of, and I think when you say question marks, but criticism maybe of the Fed's actions, and saying that, hey, okay, if inflation's a little bit above target, but we have a healthy labor market and we have a healthy overall economy, who cares? Like, stop killing it basically with
yeah,
interest rate hikes. Like, are we at a point where we can say we're good enough, right? Because yeah, inflation's a little above where we want it, but at the same time, we have a strong labor market, which means a lot of people are still in a pretty healthy position with their income. So I think that that's kind of the question marks that I'm starting to see pop up, is people say like, are we being overly aggressive at this point? And also like a lag in correction, where I've heard that there is a lag. It's not like when they do an interest rate hike that the next month we immediately see the impact of that. And
yeah,
so are we getting too far ahead of ourselves with these sustained increases, where it's like, let the lag kind of catch up and see where we're at before we continue to dig ourselves deeper? And I think what the fear is, nobody wants to find out that we went too far, right?
right.
And that we're sitting in a really bad spot that maybe was a little bit avoidable or unnecessary to damage the labor market so much. So, any thoughts there? I know it's all kind of speculative,
It's
but
yeah, no, it's a really fair question, and there's there's a good argument for that. I think that in the back of the policymakers' minds, though, is kind of what we saw in the 70s and 80s, where you risk some stopping interest rate hikes, not doing enough to curb inflation, to where you take your foot off the gas, maybe lower rates, and then you see inflation start to pick up again, and so that kind of impacts their credibility longer term. And then, if you look at kind of underlying measures of inflation, so they look
okay,
at, for example, core inflation, which
right,
strips out food and energy, and then super core inflation, which is like service sector inflation, um, which is kind of very closely tied to wage growth and the labor market, like we were talking about. there hasn't been nearly as much kind of alleviation in inflationary pressure on that front. Where we've really seen it is, energy markets, things tied to the supply chain. So materials prices, commodity prices,
Yeah.
construction costs. So the goods side, the services side is still pretty hot. And that's kind of that wage price spiral that is very bad for economic growth. And that's what they really want to avoid. So I think that, ultimately, maybe the Fed is done hiking interest rates. I could potentially see one more interest rate hike um, over the course of the next few months, but most people tend to think that, mostly done. The wait to see how it plays out with those lagged effects that you were talking about.
Right. And I think like this is a great visual aid just to sometimes even I need to remind myself that like there was definitely a very real problem that had to be addressed because if you just look at like
Yeah.
the spikes in inflation, no matter which way you wanted to dice it up or compare it, less shelter, less energy, less food, like it was not really good in any way, right? Like it looked bad across the board. And so it was going to have to be addressed. And so I think there was really a lot of agreement on that. I think the only thing that now becomes a little bit argumentative is like when was enough and have we passed that point? But again, I guess we'll wait to see how that lag catches up and how this all plays
Yeah.
out.
Might take a little bit of a near-term pain, but better for the overall
Yeah,
economic growth
I
over
think
the longer
that's
term.
the
So
mantra, right? A little
yeah,
short-term pain for long-term gain is the hope.
hopefully not
So
too much though.
well, okay, I want to move on to this question because I think that this is what a lot of people in my audience and in our industry in general are kind of anticipating. And that's just what gets us out of this? Like what helps to move the economy forward into a growth phase again out of kind of this lull that we've all been feeling. I think that there's quite a bit of numbers that would support that manufacturing is kind of been in uh, contractionary space for a while. Imports have been, I mean, compared to comparisons from the last couple of years, they've been terrible, but like we've seen declination pretty much across the board in a lot of things that go into economic activity. Again, we've seen improvement in services, but in our industry specifically, that doesn't drive as much trucking ton volumes
Right.
as goods do. So what do you see being like the catalyst, and when does that catalyst come for just broad general economic growth and some kind of stimulus into the macro economy to start seeing us move into a better spot?
Yeah, it's a great question. I think that ultimately I kind of think of there being two paths, right? Like,
Okay.
so we achieved this soft landing, quote unquote, which is for those unfamiliar, the Fed's interest rates do their job, inflation comes down in a nice gradual way, but it doesn't hurt the economy too much, right? And then, they kind of pat themselves on the back and businesses become confident again,
Yeah.
now that inflation is under control and like, yay, we did it, right? And then, ultimately though, I don't know if that's enough of like a
Mhm.
catalyst to kind of cause things to ultimately ramp back up again. So I think in that situation, you have higher interest rates for longer. Like I can't see a situation where the Fed lowers interest rates if there's no recession, right? At
Okay.
least in the near term, at least in 2024. But then the other situation is the recession scenario where, okay, the economy starts to worsen, we see job loss, consumer spending declines, and the Fed has to cut interest rates. And ultimately, that's your typical business cycle where lowering interest rates ultimately helps the construction industry come back, it helps imports come back, it helps consumer spending in the labor market eventually. So kind of perversely, maybe that's the recession on the other side of that is kind of the thing that causes this catalyst. But I think under the soft landing scenario, you might just kind of see this slower growth period for another year, 2 years,
James,
because I can't really see a catalyst.
that's not what we wanted to hear. I think like I was just talking about that literally this morning on the podcast about, we're talking about RFPs, we're talking about our industry operates on a lot of 12-month contracts, and you have to understand what the environment's going to look like essentially for 12 months to put a price to it and hold it. And I think that again, that was one of the things that I've started to hear these murmurs of 2025 where it's like everything was about 24 Q2 24, and now I'm starting to hear like these potentially people are already starting to pad for like, yeah, but what if nothing meaningful changes at all in the next 12 months? And now we're talking about 2025. And I think that almost kind of lines up with the scenario that you just outlaid, where it's like, if we quote unquote stick the soft landing, then I think we just stay kind of stagnant, if you will, for a more extended period of time, where it's like less dramatic pain, but like a really prolonged, like uncomfortable
Yeah.
economic period,
Yeah.
right?
I mean,
Or
that's,
if you see that economic recession, which would be a little bit more painful, right? But for everybody who survives that, especially on the business side in the trucking industry, like the upsides coming out of that could be greater, where you
right.
could see higher demand for fewer people left in the market, basically just based on attrition in our industry, and that would cause rates to push higher faster, and you'd see a larger recovery, at least in the industry that we do. But I imagine it would be similar in a lot of different industries as well, where you could potentially see, as interest rates come down, kind of that push for more economic activity returning in a shorter period of time, as opposed to this really long drawn out like stagnation that I would imagine would finally culminate with like very slow progress back to like rates being cut gradually, maybe in
Yeah.
25 or something like that.
Yeah.
Yeah.
Yeah, I
Well,
mean, I'm sorry I don't have better news. Unfortunately, I've gotten a lot of practice. Kind of our industry is perhaps in worse position given where
Mhm.
interest rates are. Commercial real estate investment transactions are down 70% year over year. So it's tough out there, but
Yeah.
yeah, we'll be watching it closely for sure.
Well, I appreciate the insights, even if it's not always what we want to hear. We still got to know what's going on, right? So, I appreciate you taking the time to share that. But can you let us know too? I know you shared some graphs. There was some cool information in there, but also just I think you guys do. I think you publish some work. How can people find that work, and where is that available to them?
Yeah, so if you just go to cushmanandwakefield.com and click on the insights link, you can subscribe to all of our thought leadership webinars, all that good stuff. And also, find me on LinkedIn, email, that works too.
Yeah, sounds good. Well, James, thank you so much for coming on today. And thank you to everyone who was able to join. I saw a comment by Dylan. Dylan, thanks for joining us this morning. Glad you enjoyed it. And I hope that you guys all have a great Tuesday. And thanks for meeting us for coffee.
Thank you.